Hello, everyone, and thank you for joining today's webinar, where we will talk about limited liability companies and LLPs. My name is Sudha, and I lead the tax division at Centralis. Before we kick off, I think it will be helpful to give you a bit of background about the Centralis group and the Centralis tax team. And then we will go into the purpose of today's webinar, where we will explore the key considerations, the key pointers, the key drivers towards choice of entity. There should be a chat box which allows you to write out your questions, and I'll do my best to answer those questions. You will, however, get my contact details and these slides after the presentation. So if we don't get to answer questions today, hopefully we can speak offline. And before we close off the presentation, I'll quickly run through some of the upcoming deadlines in the tax and regulatory reporting space. Centralis is a global organization with a focus on asset managers and funds. We provide corporate services such as your company and corporation, registered office, tax, accounting, payroll. We also provide fund services such as your fund admin. We have an office in Cayman, which recently acquired a company called Dainsmead. And from Cayman, we provide corporate directors to funds. And we also have an AML team, which provides AML services to funds and fund managers. Our headquarters is in Luxembourg, and I sit in the London office. In the UK, we have offices in Belfast, London, and Reading. And from the UK, we provide services to fund managers, including tax, accounting, payroll, HR consulting, and prudential. I'm a qualified chartered accountant and chartered tax advisor. I've got over 20 years experience, 12 of which are with this firm. Prior to joining the firm, I was a tax manager at BDO, where I sat in the real estate tax team, getting involved in real estate funds. And in 2008, I was involved in advising a client about the tax-selected fund regime. And at the time, the client that I was advising was the second fund to have joined the regime. It's a relatively new regime. And in 2009, the reporting fund regime came into play. And I was involved in advising a client about the regime and getting that client into the reporting fund regime. And so the combination of the TEF work, so the tax-selected fund regime advice, and the reporting fund advice, as well as the work I had done on real estate funds, that sparked my interest, and I wanted to specialize in this particular sector. And so I left BDO in 2011, and I joined the firm in the same year with the ambition of focusing on this particular sector. Over the last years, the firm has gone through a series of rebranding, and you may remember that we were once part of ACA Compliance Group, and in 2020, on the day of lockdown, the tax, accounting, and payroll and prudential teams, we span out of ACA Compliance to become Wheelhouse Advisors. And the term wheelhouse is relevant to what we do because our wheelhouse, our expertise is providing services to fund managers, and that's what we focus on. And in August last year, we joined the Centralis group, and now we're able to provide services on a global scale to fund managers and funds. In the tax team, we provide corporate and private client tax services. This is my colleague, Stuart Gartrey. He's a senior private client tax manager. And between the two teams, the type of work we get involved in, so we have your usual tax compliance, so your personal tax returns, your limited liability company tax returns, your LLP tax returns, trust returns, we get involved in all of that. Reporting funds, that's a big piece for us. We do a lot of work advising clients on whether or not to join the regime. And if you do decide to join the regime, we help you get into the regime, and then we help with the annual reporting fund obligations. Employment tax advice, so anything to do with benefits in kind, share incentives. So if you're providing employees with shares in the company or units in a fund, that's potentially a taxable event and needs to be reported. We get involved in all of that type of advice. VAT, we provide VAT advice, as well as our accounting team will do the VAT returns for you. And then estate and inheritance tax planning, that's a big thing for us right now. So a lot of our clients are reaching out to Stuart to get advice on this. And Stuart will be doing a presentation, that may be a webinar or a brunch briefing on estate and inheritance tax planning, in particular, the use of trusts and family investment companies. The purpose of today is not to say that one structure is better than the other, but really what I'd like is for people to go away and think, do we have the most optimal structure in place given the changes in corporation tax? And for those of you who are thinking of setting up a fund manager business, I hope that this presentation gives you a bit of guidance on what to think about when determining whether to go down the LLP route or the limited liability company route. So what's changed? From 1st of April 2023, the corporation tax rate increased to 25%. Previously, it was 19%. That's a big jump. So if you think about a fund manager, profits tend to be above 1 million, previously taxed at 19, now at 25%. That's a substantial increase. In addition to the increase in the corporation tax rate, the way in which you determine when corporation tax should be paid has also changed. There's been a slight change to those rules. Typically, if you're a company with profits above 1.5 million, you're required to pay corporation tax in installments starting from month 7. And if you're a company with profits above 20 million, you need to pay corporation tax quarterly. Now, before 1st of April 2023, the threshold of 1.5 and 20 million was scaled down by the number of companies within the worldwide group. And the worldwide group was essentially the parent company and the entities underneath the parent company. So in this example, you have Fund Manager Group ABC and Fund Manager Group DEF. When we're doing tax computations for the entities in Group A, B, and C, when we are working out whether or not you are above the threshold, we would scale down the threshold of 1.5 and 20 million by 3, because there's 3 companies within that particular worldwide group, A, B, and C. For accounting periods beginning on or after 1st of April 2023, the worldwide group is essentially the number of companies that are under common control. So in this example, if I'm the shareholder and I own all the shares in company A and D, which in turn owns the shares in companies B, C, and D owns E and F, the worldwide group consists of 6 companies. So the threshold of 1.5 and 20 million is scaled down by 6. And so the knock-on effect is that you may find yourself, as a result of having to include more companies within the group, having to pay corporation tax sooner than previously anticipated. So the knock-on effect there is that you've got an increase in corporation tax rate, and you may need to pay corporation tax sooner. As a result, you have to think about your liquidity requirements. So with that in mind, do we need to rethink about the limited liability company structure? Normally, when I'm talking to clients about choice of entity, I will start off with most fund managers go down the LLP route. And this is because LLPs are transparent for tax purposes, which means that the profits of the LLP are not taxed on the LLP, but rather the members of the LLP. And the individual members of the LLP are normally treated as self-employed. So this means that any remuneration paid out to the individual members are not subject to employers' NIC, which is currently 13.8%. So that's a big hit on a business's P&L. And so in this example, let's assume you have a UK LLP LLP requires at least 2 members. So let's assume we have the UK individual and he owns a company which is also a member of an LLP. The LLP is the regulated entity and has profits of 1 million. Those profits are allocated to the individual and taxed at the highest rate of income tax, which is currently 45%. And then we have some class 2 and class 4 national insurance contributions. And that takes your profits down, your net cash proceeds down to 541k. If you are an employee of a company, the company is the regulated entity in this example, and let's assume that the company has profits of 1 million. Because we have rules called the disguised investment management fee rules, the company needs to pay an arm's length salary. If you don't do that, then potentially any dividends paid out to you would be taxed at income tax rates, currently the highest rate being 45%, as opposed to the dividend tax rate, where the current highest rate is 39.35%. So the company has profits of 1 million, there's an arm's length salary of 200,000. On top of that, there's about 27 grand of employers' national insurance contributions, and that brings your profits down to 773k. There's corporation tax at 25%, which brings you down to profits of 580k. And let's assume that all of those profits are paid out to you as a dividend. You're then taxed on the dividend at 39.35%. And so the combination of net dividend and net salary takes your net cash position down to 468k. Compare that to 496k when the corporation tax rate was 19%. So that's a substantial difference. If you then compare that with the LLP structure, where your net cash position was 541k, again, substantial difference, and only enhanced by the fact that corporation tax rates have increased. So that's the reason why a lot of our clients tend to go down the LLP route. However, last year, we saw the introduction of IFPR, the Investment Firm Prudential Regime. And so when we were talking to clients about choice of entity, whilst there was focus on net cash position, we focused heavily on IFPR. And we act for a lot of US clients and Hong Kong clients who are setting up fund manager businesses in the UK. And when we talk about IFPR and the fact that regulated entities have to hold capital into the business, limiteds tend to be the preferred choice, because with a limited liability company, you don't have to pay out dividends, you retain the profits in the business. And if IFPR requires you to hold more capital into the business, well, part of that capital is from your retained profits. Compare that with an LLP, the profits of the LLP have to be taxed on the members of the LLP. And so if IFPR then says, well, we need more capital into the business, those individual members will need to source a capital from funds which have previously been taxed at income tax rates 45%, or potentially your capital proceeds, which have been taxed at the highest rate of 20%. But the point being is that with an LLP structure, you're going to have to source funds which have been taxed at a higher rate than the corporation tax rate, which is currently 25%. So limiteds are a lot easier to retain profits and help you with your IFPR requirements. Limiteds are also helpful for tax deferral. And a few years ago, I was talking to a client who was thinking about setting up an LLP or limited liability company. And he asked me, Sudha, is the only reason for setting up an LLP because of the employer's NIC saving? And I said to him, that's typically the key driver. And then he said to me, well, I'm only thinking of staying in the UK for around 10 years. And so for that particular client, going down the limited liability company route made more sense. He had his arm's length salary so that he can support his day-to-day living costs. And he retained his profits in the company. And then when it was time for him to go non-UK resident, he goes non-UK resident, and he could potentially take out those profits, retained profits, free from UK tax once he's non-UK resident. Of course, there's tax implications in his home jurisdiction, but for that particular client, tax rate was less in his home jurisdiction than in the UK. And so a limited liability company worked better for him. Limiters tend to be a lot easier to understand. So I mentioned earlier that we act for a lot of US and Hong Kong inbounds, and for them, limiteds are easier to understand. And also for individuals, it tends to be easier to understand. So with a limited liability company, you're an employee. Employees are taxed on their salary and their bonus. So the salary you get, bonus you get, that's what goes into your tax return. Your dividend is what goes into your tax return. But with an LLP, it's not always the case that your profit allocation is the same as the figure that goes into your tax return. So in this example, we assume that there was a profit of 1 million, which was taxed on the individual. So we assume that the profit allocation was the same as his taxable profit allocation. But what sometimes happens is that when you're preparing your LLP tax computation, there will be certain expenses that are not tax deductible. And so that pushes up your tax adjusted profit allocation. And so you would have a taxable profit that is more than the actual accounting profit that was paid out to you. And normally in the first few years of doing the LLP's tax return, and when Stuart goes away and prepares the personal tax return for the individual member, either Stuart or myself will get a call from the client with the question, why is the figure in my tax return more than what I actually received? And so we would have to explain that there are certain expenses that are not tax deductible. It can go the other way, where you have reliefs in the LLP's tax computation, and that brings down your taxable profit allocation. So from that perspective, limiteds tend to be a lot easier to understand. LLPs are also a lot more flexible. So we sometimes see situations where an LLP has a corporate member, and the company is providing services to the LLP, and an arm's length fee is then charged to the LLP. And in doing so, there's a profit that is captured in the limited liability company, and that could be paid out as dividends to the shareholders. There are also certain tax reliefs that are only available to companies. So R&D, research and development, tax reliefs related to R&D is only available to companies. So what you sometimes see is a company which is a corporate member or a subsidiary of the UK LLP, which is carrying out R&D activities. And from that perspective, you get the best of both worlds. You've got the company that's getting the advantage of R&D reliefs, and you've got the regulated entity, which is a UK LLP, and the individual members get the benefit of the employer's NIC saving and the higher net cash position. Sometimes we also see LLPs setting up two corporate members, and you may wonder, why have an LLP with two corporate members only? And we see that typically with a lot of our US inbounds, our Hong Kong inbounds, they set up the LLP with only two corporate members. And the reason for doing that is that it gives you the flexibility of being able to promote people to partner status. So if in the future you know that there is someone who you know can be a partner in the business, and you would promote that person to partner. And so LLPs are also flexible from that perspective. With an LLP structure, it's relatively easy to appoint an executive as a member of the LLP. That's pretty much a LLP agreement. You do need to think about the salaried member rules, which I'll talk about a little bit later. But with a company, if you're looking to give employees a stake in the business, then when you give employees shares in the company or even shares in a fund, a whole raft of complicated rules called the employment-related security rules come with that. So you need to value the shares, and that's a taxable event for the employee. So with an LLP structure, you tend to get around having to look into those rules because you're self-employed and not an employee. LLPs are also good in the sense that if you have a fund manager that's come out of a previous employment and sets up his LLP, in the first year you may have startup losses, and those losses could potentially be used against your employment income. There are restrictions to that, but essentially you can use it and you'll get some tax back from HMRC. So in summary, the net cash position under an LLP is now substantially better than in previous tax years. And most clients go down the LLP route. And as a result of the increase in CT and the substantial change, is it now the time to think about moving from a limited liability company structure to an LLP? I mentioned salary member rules earlier, and before April 2014, many LLPs were being set up with pretty much the most junior people being treated as members of the LLP, and that was to take advantage of the employer's NIC saving. And so quite rightly or wrongly, HMRC introduced the salaried member rules, which basically say if you meet certain conditions and have these features of an employee, then even though you're a member of the LLP, you'll be taxed as if you're an employee. So the employee is subject to PAYE NIC, and the LLP will need to incur the employer's NIC hit. So you'll be treated as an employee if you meet conditions A, B, and C. You have to meet all of these conditions. Condition A is that it is reasonable to expect that at least 80% of the total remuneration is disguised salary, i.e. fixed, so that's basically your gross salary, or variable, but without reference to overall profits or losses of the LLP. So that's pretty much your employee bonus. Condition B is that the member does not have significant influence over the affairs of the business, and that's referring to having a significant voice over how the business is run. And condition C is that the member's capital contribution is less than 25% of the disguised salary. So essentially, you need to put capital into the business. For most of our clients who go down the LLP route, you typically see around 6 to 8 individual members. And so for those clients, we typically rely on failing condition B. It's doable to show that those members have significant influence over how the business is run. But when you get to a setup where you have more members, and I've seen setups where you have 20 plus members, it's harder to show that every one of those members have significant influence. And so in that scenario, you need to look at whether or not you fail condition A or C. There was a case recently involving Bluecrest, and that case looked at condition B and also condition A. And that case was actually helpful because in the case where there were portfolio managers that were looking after accounts over 100 million US dollars, it was found that they actually had a significant impact on the business. And so they had significant influence. The flip side was that your non-client facing and non-investor facing staff, there was not enough evidence to show that they had significant influence. And the case actually makes the example of the head of tax as being one of those people where there was not enough evidence to show that they had significant influence. So in that scenario, you have to look at failing conditions A or C. So final thoughts. The net cash position as a result of being a member of an LLP is substantially better than it would be if you're an employee. However, HMRC are keeping a close eye on LLP structures. We've seen the Bluecrest case, and we've also seen HMRC issuing letters to clients about the mixed membership rules. That's another set of rules around anti-avoidance rules for LLPs. But where you have LLPs that have, say, 6 to 8 members, it's doable to show that all of those members have significant influence. Saying that, limiteds tend to be better for retaining capital. And so you do need to have your IFPR hat on and think about the future and being able to retain capital. Limiteds are easier to do that. You need to think it through carefully. It's not an overnight decision. And if you do want to have a chat, I'm happy to have a one-to-one. So looking at the questions, there is a question here about how easy is it to restructure. So I'm assuming that's restructuring from LLP to limited or limited to LLP. Now, the way I think about this, there are 3 stages. You have your advisory stage. So we will do the tax advice, the accounting, the prudential advice. And with the tax, there will be tax implications of moving from one structure to another. And then you've got the thinking stage. You need to think about the practicalities. So one of the other questions I can see here is about predictions on tax rates. Well, tax rules change. And so you need to bear that in mind. What if the tax rates, the corporation tax rates fall? What if tax rates get to a position where there's a level playing field, i.e. there is no net cash position difference? You know, you need to bear that in mind. And then you've got the implementation stage. Well, you need to make an application for FCA, and that typically takes between 6 to 12 months. So when you take the implementation stage into account, then you're pretty much looking at least 12 months to restructure. So I promise that I will go through some of the upcoming deadlines. So on the tax side of things, if you have short-term business visitors, so people coming over to the UK, you have a short-term business visitor filing, which is due by 31st of May. Depending on your year end, you may need to be paying corporation tax on 14th of June or 14th of July. If you're a reporting fund with a December year end, then you need to file your reporting fund computation and report to investors by 30th of June 2023. There is a grace period which takes up to October. However, at Centralis, we aim to get everything wrapped up before end of June. If you provide minor and irregular benefits to staff, that's technically a benefit in kind. So your staff entertaining your Christmas party, that's a benefit in kind. But what you can do is enter into an agreement with HMRC where the employer pays the tax and NIC on behalf of the employee. And that's an application. So you need to apply for it by the 5th of July. And the calculation needs to be submitted by 31st of July. And for those of you who have awarded shares to employees or issued units in a fund to employees, then that needs to be reported on a ERS return, an employment-related securities return. And that needs to be submitted by 6th of July. And then, of course, you've got your payments and accounts. So if you're on the self-assessment, which most of you probably are, you would need to pay your second payment on account by 31st of July. On the regulatory side of things, then most of our clients have been busy with audit. So if your December year end, your audits need to be finalized by 26th of April. So our accounting team have been busy with helping our clients with that. Your close links and controller reports need to be submitted by 2nd of May, together with the remuneration report. You've got your quarterly financial prudential returns, which need to be due by 3rd of May. Economic crime levy hasn't been on people's radar, but that's really, really important. And that needs to be finalized by 18th of May. Your quarterly consolidated financial and prudential returns need to be in by 18th of May. And your quarterly Annex 4 returns need to be in by 2nd of May. So hopefully the presentation was helpful. You will get the PowerPoint slides and also my contact details and Stuart's contact details. Happy to have a chat with you. Please feel free to get in touch with us and hopefully speak to you soon. Thank you.